Hey everyone, this is Shourya from Seta Capital, and welcome back to Secondary Simplified, where we break down private market concepts in under 2 minutes. Today's topic is continuation vehicles, or CVs. These are essentially new funds that are created by a GP to acquire one or more assets from an existing fund or funds that the GP manages. Rather than exiting high performing assets too early, the GP gives it more time and capital to grow by moving it into the CV. Now, CVs with one asset transferred into the SPV, they're known as single asset CVs, whereas if more than one asset is transferred, it's known as a multi asset CV. So, why pursue it? Well, they offer benefits across the board. For LPs in the original fund, they have the option to sell and take liquidity or roll into the new vehicle. For secondary investors, they get access to high quality and seasoned assets, whereas for the GP, they get more time and more capital to realize full value without a forced exit. And what does the process look like? Well, the GP initiates the process. They select the asset or assets and structure the CV. They'll typically engage a secondaries advisor or banker to run a competitive process and ensure that the pricing they receive is market based. LPs are then given full information in a 20-day period to decide whether they want to sell or roll into the CV. How does the carry work here? GPs usually would roll their carry into the CV so that they can reinforce alignment. And rolling LPs typically receive adjusted terms so that they're not really double charged carry or end up in no way worse off economically. Let's talk about the key risks here and how they can be mitigated. Well, the first one is valuation disputes, which are mitigated through a market clearing process and obtaining a third party fairness opinion. For conflicts of interest, they can be mitigated by running a competitive advisor led process that creates transparency and arm's length pricing. Fee and carry structures are typically addressed by ensuring that the rolling LPs are treated on a no worse off basis with a clear disclosure of terms. And unequal treatment between sellers and rollers, these are mitigated through aligned economics and clear documentation. And as always, these are complex transactions. It's essential to seek independent legal advice to fully understand the risks, terms, and implications of any CV deal. Bottom line is they unlock long term value, but getting the structure, governance, and alignment right is critical. Thanks for watching Secondary Simplified, and you can follow us here for more insights into the evolving world of the private markets.